Good day, everyone. I am Jamaica Baay, and today I am going to discuss the three topics, which are the mergers and acquisition or M&A, investment banking, and portfolio management. So our first topic is all about mergers and acquisition. Let's define the learning objectives. The first one is describe the different types of mergers and acquisition, the horizontal, vertical, and conglomerate. The second one is analyze the strategic rationale behind M&A transaction. The third one, identify the key steps involved in the M&A process, including due diligence and integration planning. So mergers and acquisition. What is mergers and acquisition? Are a business transactions in which the ownership of companies, business organizations, or their operating units are transferred to or consolidated with another company or business organization. So a merger is an agreement in which two companies join together to form one company. Acquisition is when one entity takes ownership of another entity's share capital, equity interest, or asset. So if you are a shareholder in a company that goes through a merger, you may end up receiving shares in the new company. If you own an acquired company, you will either receive cash for the stock you own or shares in the acquiring business. If you own shares in the acquiring company, nothing changes except the value of your shares might change, for better or for worse. So we have the different types of mergers and acquisition. We have the horizontal mergers, vertical mergers, and conglomerate mergers. Under the conglomerate mergers, we have the pure and mixed. A horizontal merger is a merger between two companies in the same industry. This type of merger involves two businesses that offer the same products or services to the same kinds of customers. With a horizontal merger, the two businesses are direct competitors to one another. For example, say you own a bakery and decide to merge with another bakery in town. You would be merging with a direct competitor and would be fusing together to form one bakery. The second one is the vertical mergers. It involved two companies in the same industry operating in different production stages. This could involve a retailer who merges with wholesaler or a wholesaler merging with a manufacturer. A well-known example of a vertical merger is the deal between eBay and PayPal. Conglomerate mergers occur between two companies whose business activities and industries may be completely unrelated. So in pure conglomerate mergers, the two firms may continue to operate separately within their own markets, whereas in a mixed one, they may look to expand product or market reach. For example, one may be a software company and the other one may be a clothing company. So, the pure, it involves two companies that have nothing in common and no similar offerings. Whereas the mix, companies are looking to expand their offerings or market reach by joining with another company. We have here the strategic rationale behind mergers and acquisition or M&A transaction. We have here the unlocking synergies. The common rationale for mergers and acquisition or M&A transaction is to create synergies in which the combined company is worth more than the two companies. Higher growth. An organic growth through mergers and acquisition is usually a faster way for a company to achieve higher revenues as compared to growing organically. Stronger market power. In a horizontal merger, the resulting entity will attain a higher market share and will gain the power to influence prices. Vertical mergers also lead to a higher market power, as the company will be more in control of its supply chain, thus avoiding external shocks in supply. Diversification. Companies that operate in cyclical industries feel the need to diversify their cash flows to avoid significant losses during the slowdown in their industry. Acquiring a target in a non-cyclical industry enables a company to diversify and reduce its market risk. Tax benefits. Tax benefits are looked into where one company realizes significant taxable income, while another incurs tax loss carryforwards. Acquiring a company with the tax losses enables the acquirer to use the tax losses to lower its tax liability. Key steps involved in mergers and acquisition process. Through these steps, this should help you with your preparation at the start of the process to ensure you achieve a successful acquisition and integration. Step 1. Strategic planning, target identification, and initial research. So what do you mean by that? The first step is to identify the target or potential buyers. If you are selling and start exploring whether the target would be a good fit for the existing business. Identifying any synergies between the businesses and thinking about what changes may be necessary to complete a successful integration. The offer. If everything looks good after the first step, then the second step is to agree with the key terms of the deal. For example, structure, timing, price, conditions of the deal. This will typically be set out in a letter of intent, also called term sheet. Step 3 is due diligence. It is the process which is an information gathering exercise performed by the buyer on the target. Now, the aim of the exercise is to allow the buyer to elicit sufficient details about the target in order to reassure the buyer that the acquisition should go ahead and that the terms of the deal make commercial sense. Step 4, the legals. This step involves the parties' lawyers drafting and negotiating the terms of the transaction documents. The main document being a sale and purchase agreement containing the terms and the deal agreed between the parties, based on the heads and any adjustment required due to the things arising in the due diligence process. Step 5, completion or closing the deal. The closing stage or completion of a transaction requires a great deal of planning and organization to ensure all the necessary paperwork is agreed and ready to sign on both sides. Step 6. Post-closing and post-merger integration. So, there are usually a number of matters to be completed by the parties and their legal terms post-closing. This could be filing at company's house, paying stamp duty on shares, or issuing notices to customers and suppliers. Step 7. Monitoring and evaluation. Post-acquisition audits are a tool used by many businesses to monitor the success of an acquisition. It typically involves a review of the M&A process and assessment of the success of the integration. So for our second topic is all about investment banking. Let's define the learning objectives. Explain the role of investment banks in capital markets, including underwriting, mergers and acquisition advisory, and financial restructuring. The second one, analyze the different financial products and services offered by investment banks. The third one, identify the valuation techniques used by investment banks to evaluate companies for M&A transaction. So investment banking, what is its role in capital market? The investment banking is the concept whereby a financial service organization or a division of a bank provides consulting services to government, individuals, and corporations regarding underwriting, capital raising, mergers, and acquisition to raise funds. So, through IPO, an investment bank plays a key role in connecting firms with potential investors. So, basically, investment banks provide stock underwriting services to companies that elect to go public and seek equity finance. So, an investment bank's principal role is to help businesses and governments solve their financial issues as it serves as an intermediary between a company and the investors. So the role of investment banks in the capital market. We have the underwriting. So investment banks also underwrite other securities like stocks through an initial public offering. When an investment bank underwrites stock or bond issues, it also ensures that the buying public or primarily institutional investors such as mutual funds or pension funds commit to purchasing stocks or bonds before it actually hit in the market. Mergers and acquisition advisory. Investment banks provide advisory services to companies involved in mergers, acquisition, divestitures, and another corporate restructuring transactions. So they help clients evaluate strategic alternatives, identify potential acquisition targets or buyers, negotiate deal terms, and facilitate transaction process. So third one is financial restructuring. Investment banks assess and debt restructuring, equity issuance, crisis management, and turnaround strategies. So financial restructuring. They help companies negotiate their terms, issue new equity, navigate crises, and implement strategies to enhance profitability and financial stability, ensuring sustainable business operation. Products and services offered by investment banks. Investment banks offer a range of services including underwriting, sales, equity research, and asset management. So underwriting, capital raising, and underwriting groups work between investors and companies that want to raise money or go public via the IPO process. So this function serves as the primary market or new capital. Mergers and acquisition. It is the advisory rules for both buyers and sellers for businesses managing the mergers and acquisition process start to finish. Sales and trading. Matching up buyers and sellers of securities in the secondary market. Sales and trading groups in investment banking act as an agent for clients and also can trade the firm's own capital. Equity research. The equity research group or coverage of securities helps investors to make investment decisions and supports trading of stocks. And the last one is the asset management. Managing investment for a wide range of investors, including institutions and individuals, across a wide range of investment and styles. We have here the valuation techniques used by investment banks. Investment bankers use various valuation techniques to evaluate the value of a company or asset. The most common valuation techniques employed in investment banking includes discounted cash flow or DCF, leverage buyouts or LBO, comparable company analysis or CCA, precedent transaction analysis or PTA, and relative valuation methods. So, discounted cash flow or the DCF analysis is a widely used investment banking valuation technique because it estimates the present value of a company's future cash flows by discounting them back to their current value using a discount rate. So the discount rate is usually determined by the company's cost of capital. So leverage buyout are a type of investment transaction where a company is acquired using a significant amount of leverage or debt. LBO are a popular investment banking valuation technique used to determine the value of a company based on its potential to generate cash flows that can be used to pay down the debt used to acquire it. Comparable company analysis. or CCA is another widely used investment banking valuation technique used to assess the value of a company by comparing it to similar companies in the market. Investment bankers use financial metrics such as earning per share, price to earning ratios, and enterprise values to evaluate a company in comparison to its peers. It helps potential investors and underwriters understand a company's relative value in the market. So the fourth one is the precedent transaction analysis, or PTA. It is an investment banking valuation technique that evaluates the value of a company based on the price paid for similar companies in previous transaction. So it is used to provide a benchmark for the valuation of a company that is being considered for acquisition or merger. And the last one is relative valuation methods. So relative valuation methods are used by investment bankers to estimate the value of a company by comparing it to other similar companies in the market. So this approach involves the use of ratio and metrics such as earning per share, price to earning ratios, and price to sales ratios. So they are widely used in investment banking valuation techniques and help in evaluating the worth of a company and in comparison to its peers. So our third topic is all about portfolio management. For the learning objectives, the first one is explain the process of constructing and managing a diversified investment portfolio. The second one, evaluate different asset classes like equities, bonds, and alternatives and their suitability for different investor risk profile. The third one is analyze and select investment vehicles such as mutual funds and ETFs for portfolio construction. What is a diverse portfolio? A diverse portfolio is one that's made up of a mix of investment. So the process of constructing and managing a diversified investment portfolios are determine your investment goals and risk tolerance. So before you start investing, it's crucial to understand your financial goals and your risk tolerance. When we say financial goals, it is your retirement, like buying a house or education. So risk tolerance is your ability and willingness to lose some of all your original investment in exchange for higher potential returns. Number two, asset allocation. Asset allocation is the process of dividing your investment portfolio among different asset categories, such as stocks, bonds, real estate, and cash. The right mix depends on your goals, risk tolerance, and investment horizon. Generally, younger investors can afford to take more risk, while older investors may prefer a more conservative approach. Diversification. So diversification involves spreading your investment across various asset classes and within those asset classes to reduce risk. The idea is that different assets will react differently to the same economic event, reducing the overall risk. Select investment. After determining, select investment. After determining your asset allocation, select a specific investment. Research individual stocks, bonds, and mutual funds. Look at the factors such as performance history, fees, and management. So number five, regular monitoring and rebalancing. Monitor your portfolio regularly to ensure it remains aligned with your goals. Over time, some investment will perform better than others, which can skew your original asset allocation. Rebalancing involves selling and buying assets to restore your portfolio to its original allocation. And the last one, stay informed and adjust. Stay informed about market trends and economic news. Adjust your portfolio as needed based on changes in your financial situation, goals, or market condition. However, avoid making impulsive decisions based on short-term market fluctuation. The different asset classes, the equities, bonds, alternatives, and their suitability for different investor risk profiles. We have the equities or stocks. Equities represent ownership in a company and entitle the investor to a portion of the company's profit, typically through dividends and capital appreciation. So the equities have offered higher returns compared to other asset classes over the long term. However, they are also more volatile and can experience significant short-term price fluctuation. So for the suitability, aggressive investors, equities are well suited for aggressive investors with a high risk tolerance and a long investment horizon, like 10 years. Younger investors or those saving for long-term goals often allocate a larger portion of their portfolio to stocks. So for the moderate investors, investors with a moderate risk tolerance may also invest in equities but will balance their portfolio with more stable assets to reduce overall risk. So the second one is the bonds. Bonds are fixed income securities where the investor loans money to a borrower in exchange for periodic interest payment and the return of the bonds at face value when it matures. So bonds are generally less volatile than stocks and provide a predictable income stream. Bond prices are inversely related to interest rates. So when interest rate rise, bonds prices fall and vice versa. So for the stability, conservative investors. Bonds are ideal for conservative investors who prioritize capital preservation and steady income over high returns. Retirees and those with short to medium-term financial goals often favor bonds. Moderate investors. Bonds are also suitable for moderate investors as part of a balanced portfolio to offer the volatility of stocks and provide diversification. The last one is the alternatives. Alternatives investment include assets such as real estate, commodities such as gold and oil, hedge funds, private equity, and cryptocurrencies. These assets often have low correlation with traditional asset classes like stocks and bonds. So for the suitability, aggressive investors. Alternatives are suitable for aggressive investors that are willing to take on additional risk for the potential or higher returns. Investors with a higher net worth and those seeking portfolio diversification may allocate and portfolio to alternatives. For the moderate investors, moderate risk tolerance investors may include a smaller allocation of alternatives to diversify their portfolio while being mindful of the higher risk and complexity. So analyze and select investment vehicles such as mutual funds, ETFs for portfolio transaction. So what is an investment vehicle? So it is a product used by investors to gain positive returns. It refers to any method by which individuals or businesses can invest and ideally grow their money. So there are types of investment vehicles. We have the ownership investment. And ownership investment includes stocks, real estate, precious objects, and businesses. Stocks, also called as equity or share, give investors a stake in a company and its profits and gain. Lending investment. With lending investment, people allow their money to be used by another person or entity which the expectation it will be repaid. So the lender typically charges interest on the loan so that they earn a profit once the loan is repaid, including the interest changes. This type of investment is low risk and provides low rewards. Example on lending investment includes bonds, certificates of deposit, and treasury inflation protected securities or the TIPS. Investors investing in bonds allow their money to be used by corporations or the government. With the expectation it will be paid back with a profit after a set period of time. Cash equivalent are a financial investment that are considered as good as cash. These are savings accounts or money market funds. The investments are liquid but with low returns. The pooled investment vehicles. Multiple investors often pool their money to gain certain advantages they would not have as individual investors. This is known as pooled investment vehicle and can take the form of mutual funds, pension funds, private funds, and unit investment trust. So I am Jamaica Bai, and that's the end of my discussion. Thank you.